And that really brings us to the question of today's episode, and that is, well, should we take our dividends as income, or should we be reinvesting them? Well, let's start by talking about why you would just take them as income. Now, the best reason to take dividends as income would be that you have some specific purpose. You have some specific thing that you are needing to pay for, that you are needing to fund. For instance, one of the best examples would be retirement. A lot of people use dividend paying stocks in retirement so that they receive income off of these stocks, right? And that income pays for their lifestyle. They're not making money in the way of salaries and wages anymore. And so they need money to be coming into them some way, somehow, via their investments, and dividends are a good avenue via which that can occur. So that's perfectly fine, right? Taking them as income in that case is perfectly fine. Or, right, if you have something over the course of your life that you can use dividends to pay for, such as your kids' college, right? Maybe you have a nice brokerage account that you can use dividends to pay for your kids' college. That would be really nice. Or you can, take your dividend income and do something like, pay off a house if that's what you want to do, or whatever, right? There are some specific purposes for which using dividend income could be a good idea. But anything that you do with dividend income is always going to eat away at your returns. Okay, is always going to eat away at your returns, because you also have the option of reinvesting your dividends. Okay, you do not have to take your dividends as income. When companies pay dividends into your account, whatever brokerage house you use for your investments, they give you the option when you set up an account, and you can go in and change it at any time if you want to reinvest dividends or not. And reinvesting dividends, what that is it's taking that income that the company is paying you. And so in the case of AT&T, that $2.08 over the course of the year that AT&T is going to pay me, and reinvest that money into AT&T stock. Reinvest it into the thing that paid you the dividend. Okay. And so by doing that, what you get is you get more of that particular thing that paid you. Okay. And your dividends will actually compound as well. Meaning, right here, you're making 6.72% on a $30.92 share of AT&T. But if you reinvest your dividends, right, then you're going to hold more than just a $30.92 share, right? The amount that you hold is going to increase. Therefore, the amount of dividends that you'll get paid will subsequently increase. Okay, so it allows you to make money on money that is being paid out to you as an investor. So you can take that money and reinvest it into whatever paid you that particular dividend. Now, in my opinion, you should always reinvest your dividends unless you have some specific need, right? Retirement makes perfect sense, or having to pay for something like a kid's college or something like that, right? That you're going to have to pay for, and you expected to pull off of investment accounts in order to do, then using dividend income is not such a bad idea. But any other situation, right? If you're just trying to create quote unquote multiple income streams, right? If you're just trying to bring more money in every month, do not do it via dividend income. It's not a good idea typically, because you could be growing your accounts to far, far more than what your accounts are going to grow to for you, because you are taking the dividends off of your accounts. And you may be thinking, well, what's the big deal, right? Are these dividends such a big part of what's going on within my account that they're going to really eat away at that much of my returns over time? Well, in short, yes. Right now, AT&T is a very extreme example because they have a 6.72% dividend yield that is very, very high. Right? Most companies that are paying dividends are paying less than 2% as far as dividend yields go. And so you may say, well, if a company's paying less than 2%, how is that really going to eat away at my returns over time if I'm taking that 2% off for myself? Well, let me just give you the numbers, especially for the S&P 500, right? Because we use the S&P 500 as our benchmark index because it's 500 of the largest companies in the United States, right, at any given time. And so if you just looked over the last 50 years, you look from 1971 all the way to 2021, okay? And you looked and you said, okay, what is the S&P 500's annualized return? Well, the annualized return of the S&P 500, if you just took the price, right, the price of the company stocks, right, and you said, what's the return? That return is 7.635%. which is a wee bit underwhelming considering that we typically consider closer to a 10% rate of return for the S&P 500, the return that we would expect to receive over the long term. So that's a little bit underwhelming. But that return is not all that there is. That only has to do with price. That is your capital gains return, right? That is your capital appreciation return. If you took the dividends that you could have made off of the companies in the S&P 500 and reinvested them, right, over the course of that 50-year period, instead of making a 7.635% return, you could have made a 10.713% return. Okay, so this is over a 3% difference between not reinvesting dividends and actually reinvesting dividends. And again, 3% to a lot of people does not sound like much, but over a 50-year period, that can make a huge, huge difference. Now, you may ask how big a difference exactly? Well, I think the difference will really surprise you. Okay, if you had $10,000 and you invested it in 1971, April of 1971, and held it until April of 2021, okay, and you invested it in the S&P 500 and you only took the returns as far as the price. Okay, now obviously you would receive the dividends that the companies paid, okay, but you would put those in your pocket and use them as income. So we're going to treat those dividends as spent. Okay, so even though you could have spent those dividends, right, you did not reinvest them. But let's just say what's in your account after 50 years? What's in your account after investing $10,000 50 years ago and letting it grow just by the price? Well, if you just let it grow by the price of the S&P 500, you would have $395,982.29 based on just the price, right? That $10,000 would have grown to that amount, which is no slouch, right? It is still a fair amount of money to grow $10,000 into, okay? But that was at the 7.635% that I was talking about just a moment ago. But if you took your dividends and reinvested your dividends back into the companies that paid them, right? Back into that S&P 500 index or whatever you're investing in to get the S&P 500 returns, right? Instead of $395,000, right, you would have had $1.62 million in an investment account in 2021 after 50 years of investing just that initial $10,000 investment. Okay, so you see that this is a vast difference. Right, reinvesting dividends makes a huge, 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 huge difference. And so if you're sitting there thinking, well, what about all those dividends that got paid to me, right? What about all those ones that I used as income? Apparently those were useful to me still, and I got paid those dividends, so you're missing a little something in this calculation. Well, yes, and I didn't go in depth to try to see exactly how much you would have gotten paid in dividends, but I can tell you this. Just based on the time value of money, just based on how those dividends reinvested would grow and how I know that occurs, the dividends that you would have received are not near the gap that you see between these two values, right? The gap that you see between these two values is over $1.2 million in gap, right? And so on a $10,000 initial investment, there's no way you would have made $1.2 million in dividends, especially when we know that our dividends are based on what we have invested at the time. And you see that that one account only grows to $395,000, right? So the amount of dividends that you would have made would never have touched the difference between these two different accounts, right? And so reinvesting your dividends is going to allow you to make higher rates of return.